This company in Ireland paid a fine of 100,000 euros and this company in UK paid a fine of 315,000 pounds and this company in Australia paid a fine of over 1.1 million Australian dollars. But why are these fines paid for? These fines are levied on these companies for non-compliance of an accounting standard, IFRS 15, contract with customers. So what is so special about IFRS 15? Let us understand IFRS 15 with a very simple example. Imagine you are a rock star and you are trying to impress your record label with your album sales. You ship a bunch of CDs to a store, but they haven't sold yet. Do you count those CDs as sold or not? I mean, revenue recognized or not? Before IFRS 15, it was like you were saying, hey label, I sold those albums, even though they're still sitting on the store shelf. But with IFRS 15, it's like label says, hold up rockstar, you can only count those albums as sold when the customer has bought them and taken them home. That is, the control has been transferred. So you have to wait until the customer has actually purchased the album and it has in their hands on their phone before you can recognize the revenue. In short, IFRS 15 is like making sure you don't count your album sales before they are actually sold and in the hands of your adoring fans. IFRS 15 is a 5-step model, not those models. Step 1, identify the contract. Step 2, identify the performance obligations. Step 3, determine the transaction price. Step 4, allocate the transaction price to the performance obligations in the contract. And step 5, recognize revenue as and when the entity satisfies a performance obligation. Wow, this is so simple. Then why are these companies paying such heavy fines? Well, this example is just the tip of the iceberg. Step 1, identify the contract. A contract is an agreement between two or more parties that creates enforceable rights and obligations. The contract must have these elements: parties, purpose, price, payment terms, goods or services to be transferred. The contract must have commercial substance, that is, it should not be just a mere formalism. The entity must have the ability and intention to enforce the contract. For example, let's take Apple enters into a written agreement with Best Buy to sell 100 iPhones for $10,000. This contract meets all the necessary elements and is enforceable by both parties. Step 2, identify the performance obligation. A performance obligation is a promise to deliver a good or service to a customer. It can be a product or service or a bundle of both. The entity must identify all the performance obligations in the contract. A performance obligation must be distinct, that is, it can be separated from other obligations, identifiable, that is, it can be explicitly stated or implied in the contract. For example, let's take Apple promises to deliver 100 iPhones with a 1-year warranty and technical support service. Now in this, there are 3 separate performance obligations. Step number 3, determine the transaction price. The transaction price is the consideration, the amount of consideration, that is the payment, the entity expects to receive in exchange for transferring the promised goods or services. It can be fixed, variable, or a combination of both. The entity must consider these: the stated price in the contract, any discount or rebates, any price concessions or rebate or adjustments, any financing components, for example, interest rates. The transaction price must be measurable, that is, it can be reasonably estimated. From the early example, the contract specifies a price of $10,000 for 100 iPhones. Apple offers a 5% discount for early payment, which Best Buy accepts. The transaction price is $9,500. Step 4, allocate the transaction price. The entity must allocate the transaction price to each performance obligation in the contract. This is done based on the relative standalone selling prices, also known as SSP, of each performance obligation. The SSP is the price the entity would charge for each performance obligation if it were sold separately. The allocation is done using a method that is consistent with the principles of IFRS 15. From the earlier example, Apple estimates the standalone prices for each performance obligations as iPhones $8,000, warranty $1,200, technical support service $800. The transaction price of $9,500 is allocated based on the relative SSBs. iPhones would be $7,600, which is 80% of $9,500. Warranty would be $1,140, and technical support service would be $760, which is 8% of $9,500. Step 5. Recognized revenue. Revenue is recognized as and when the entity satisfies a performance obligation. This is done by transferring control of the goods or services to the customer. Control is transferred when the customer has the ability to direct the use of the goods or services and obtain substantially all the remaining benefits. Revenue can be recognized at a point in time, for example, when a product is delivered, or over the time, example, when a service is provided. From an earlier example, Apple delivers 100 iPhones to Best Buy on 1st January 2024. Control of the iPhones has been transferred to Best Buy on the same date. Revenue of $7,600 is recognized on 1st January. The warranty service would be provided over the next year, and the revenue of $1,140 will be recognized over that period. The technical support services will be provided over the next year, and the revenue of $760 will be recognized evenly over that period. Please note that these examples are simplified and may not represent all the complexities of the real-world contracts. So why do these companies like CNC Group, BP and Tesla pay such heavy fines? Is it because they failed to follow these steps, or they did not follow them correctly? Maybe they recognized revenue too early, or they did not allocate the transaction price correctly. There can be multiple reasons. So here's the thing. IFRS 15 is not meant to be a punishment. It is meant to be a framework for transparency and consistency. By following these steps, companies can ensure that they are reporting their revenue properly and that their investors and stakeholders have a clear picture of their financial performance. This video is just a basic level knowledge of IFRS 15, and it is not the entire IFRS 15. In case you have any doubts, please comment below. Also, I have a revenue audit work paper which I would love to share. Please comment your email ID below and I'll share the work paper to you. This is Rohit Nair signing off. Thank you.